A very warm greetings, everyone. Welcome to the series of Introduction to Environmental Economics. Under this, we have been talking about environmental regulation. Today, we are going to talk about impact of emission taxes and subsidies on firms. Part 1. In this lecture, we will be comprehending about the impact on firms after imposing fees and subsidies used for emission reduction. We will visualize the differences in using subsidies for pollution control rather than imposing the fees on polluters. So both the sides we will be visualizing, whether it is beneficial for the firms to impose the taxes, emission taxes or subsidies. To understand the short run and long run impact of subsidies and fees on the firms. We will also comprehend the concept of dead weight loss due to piggyback tax under the regime of regulated and unregulated monopoly. We will visualize whether too little or too much of pollution is inefficient for the economy. Whether what is the point of efficiency is something which we are going to examine in the lecture. Now let us start with the fees versus subsidies scenario. Let us discuss in detail that what are the advantages and disadvantages of imposing a fees in comparison to subsidies. What is an emission fee? An emission fee is a price or a fee paid by the polluter to the regulatory authority or entity for every unit of emission the polluter emits. Can subsidizing the firms result in the same type of output? This is what we are going to investigate. In other words, is it possible to obtain the same amount or the results by subsidizing the firm to reduce pollution? So we are trying to see the trade-off, or we are trying to see the possibilities of reducing emission using the subsidy in comparison of imposing the emission fee. So which one is going to have what consequences on the firms? It is observed that subsidies are more politically popular because it is the payment or it's the transfer from government to the entities, units. So therefore, they are more politically popular than the taxes or fees. The two approaches vis-a-vis like subsidies and taxes, the two approaches, they result in different outcomes. This is but natural because the one is a transfer from government to the entities, producing entities, and the other one is a payment from entities to the government. So there is a reverse flow of monetary flow from both the units. The tax is supposed to be more efficient, whereas it is considered that subsidy can result in too many firms in the industry because it's a payment you receive from the government for reducing the emissions. So more firms would like to join and they incentivize to join the industry. This in turn results in an inefficient outcome or amount of not only the pollution but also the good associated with the pollution. So once we talk about subsidies, it is expected that more firms join the industry and finally they result into producing more, not only more pollution but more of the good associated. Now let us consider in-depth analysis of the two scenarios to visualize the impact of subsidies and taxes on emissions as well as on the firms. Now it is very natural that both the tools or regulatory instruments, they are going to affect the cost curves of the firms. And once they affect the cost curve of the firms, they will affect funds in the short run, and they will also affect in the long run. So in the short run, we consider that there is no time for the new firms to enter the industry. Therefore, short run is considered a short time period where there are no new firms joining the industry. On the other hand, we consider long run, it is a time that for entry and exit, there is lot of time given for the firms to decide whether to enter the industry or exit the industry. However, exit or the shutdown possibility is always available or possible even in the short run. A firm is free to exit or shut down even in the short run, but there is no scope of entry to the industry. Now let us discuss in detail the short run scenario when we take two types of cases here. First case is the identical firms scenario where all the firms are identical, means the technology which they are using is similar. Let us consider competitive industry here producing a good, and along with that good there is an adequate amount of a substantial amount of pollution getting generated. Now here we assume that initially all the firms belonging to that industry are identical. Under the pollution tax, we suppose impose a pollution tax equal to the amount small t. The production cost curves are going to definitely get affected for this typical firm which we are seeing on the screen. The equation tells you the total cost. How does it get affected if you impose a tax fee, emission fee T on an emission which is represented by a small e per unit emission. So the total cost will get affected in the following way, that it is equal to the variable cost plus the fee charge which one has to pay because of emission. So T into E is the total payment due to emission plus the fixed cost. So as we all know that total cost is a combination of variable cost and the fixed cost. So the way it gets affected, modified, is that you add one more portion of the fee which is equal to T into E. Here in this equation, Y is the total amount of good being produced, E is the emission which comes along with the production. Therefore, the VYE, the variable cost of production, is a function of amount generated, and along with this the emission generated, amount of good produced plus the emission generated. And the fixed cost FC of the production is the fixed cost of the total production. Consider this fixed relationship between Y and emission, that is output and emission. So here another assumption, we assume that the emission has a constant proportion with the output. We consider there is a fixed relationship between the output and emission, and this is given by E equal to A into Y. So in other words, it means as we produce more and more we are going to pollute. So E is a positively related with Y, and A, which is the constant, is a positive constant. There is no way you can reduce pollution unless you make some provisions for that or more expenditure for that. So E is equal to AY. So that is how our total cost function gets affected. So the total cost function is represented as equation 1. One can also say that the total cost is finally a function in Y. Y is the total production of the firm which is given by the good. So we can express the entire equation in terms of Y, total cost as a function of Y. which can be broken down into variable cost, which is again a function in y, plus TAY. Now TAY is nothing but tax on emission, which is again a function in y, plus FC, which is a fixed cost, which comes as a lump sum cost. Now let us look at what other kind of costs variants get affected due to taxes. The marginal production cost curve is the derivative of total cost with respect to y. So MCY, which is the differentiation of TC with respect to y, is given by MVCY plus AT. So this is how this implies that with the imposition of tax on emission, the marginal production cost is, as you can see, that it increases by 80. So MCY is equal to MVCY plus 80. 80 is the amount of taxes collected per unit of emission. Now we consider this was the case when we talking about the taxes on emission. Let us see what happens if instead of paying the taxes on emission, we subsidize them. We give subsidy for reducing emission. Now for seeing the scenario or examining this scenario, we consider certain assumptions. We consider a subsidy of small s being given to the firm by the regulatory authority. Suppose a firm can pollute at a level which is defined as E hat. This is the maximum limit possible to pollute, and there is an attention to the pollution control, and that is what the gap has to be subsidized by the government. So with a subsidy, what we mean is, with a subsidy, firm will be paid to reduce the emission, and that should fall under E hat. If the firm reduces the emissions to E, the subsidy will be paid equal to S into E hat minus E. So the portion by which it reduces its emission is subsidized by the government, and that units of the emission reduction are multiplied by the per unit payment decided by the government. So how do the costs variance of the firm get affected due to the subsidized payments? Let us see the total cost first. How does it get affected? The total cost, which is a function in y, is equal to the variable cost, which is VCY, plus the fixed cost. Now this entire total cost gets affected because you are getting a payment from the government in the form of subsidy for reducing the emission. Therefore the total cost gets reduced, and therefore we have a last component in the equation, which is minus S into E hat minus E. So the last component gets reduced, it reduces the total cost and by the amount given in the last term. Now in other words, we can just refine and modify the equation and see it on the screen that TCY is equal to VCY plus SAY plus FC minus SE hat. So it means that your total costs have been reduced the once you get the payment in the form of subsidy from the government. The last term is the fixed cost minus the lump sum transfer which you receive from the government. So as a result, you can see the total cost in case of subsidies gets reduced, while there was an increase in total cost in case of tax emissions, emitting taxes on emissions. And what happens to the variable cost? Variable cost, as a matter of fact, in both the cases, in taxes as well as in the subsidies, it remains same. So the variable cost is unaffected. The fixed costs are different and they are they constant. So consequently, we see that in the short run case scenario, the marginal cost of production will be identical to the two firms. Once we take the marginal costs, you can again uh, differentiate the marginal cost in case of subsidy scenario and see that MCY is equal to MVCY plus AS. Earlier we were having MCY, MVCY plus AT. So you would see that there is an identical impact or same impact on the marginal cost production curves. In both the cases, firm will produce same amount of pollution and the good. This equation tells us that consequently in case of identical firms in the short run results applies even if there is more complex relationship between the emission and the output. Emission and the fixed we considered here a fixed ratio which is A, but even if we considered a complicated relationship, marginal cost curve is going to be same when you consider case of taxes or emissions. Now let us take our discussion from the identical firms to heterogeneous firms. Now we discuss the second case scenario, which is a heterogeneous firm scenario. Firms here are heterogeneous in nature. Now what do we mean by heterogeneity here? It is because of the differences we find in the technologies they use. Suppose an industry comprises of two types of typical firms. One set of firms are the firms which are using the old technology. They are considered as old firms, and the ones which are using a new technology considered as new firms. Newer firms may have fixed costs but lower variable cost. This is how we define our new firms. So the characteristic of new firms considered in this scenario are the ones which are fixed cost but lower variable cost. In the short run, we are doing the short run scenario. So within the short run scenario, we consider no new firms can enter the industry. However, in the short run, any firm may choose to exit and produce nothing or shut down. If the firm shuts down and produces nothing, then the subsidy also disappears. We have to take care of that scenario also, because the subsidy is when you produce and you produce along with your production the emission. Only then the subsidies are considered. This implies that we pay the firm to produce less pollution, but we do not pay the firm if they decide to shut down and not to produce. So the payment of subsidies only when the firms decide to produce less pollution. Otherwise, there is no payment. So in this short run scenario, when the firm decides to shut down, there are no payments of subsidies given. As you can see the graphs, that on the left hand side there are old firms. On left hand side graph there are old firms, on the right hand side graph there are new firms. In the old firm scenario, we will consider only two graphs, two versions of cost, average variable cost and the marginal cost. Since the total cost is irrelevant in the short run scenario, therefore we consider only the variable cost and marginal cost. As we can see that average variable cost, when there was unregulation, if there was no regulatory instrument being applied to the firms, then AVCU is considered as that component. AVCT, so let us just quickly see what type of figures or the kind of versions of cost curves we are discussing. MC curves and AVC curves for the old firm and new firms. In the case of short run, we are not concerned with total cost, as we already said. The concern is whether the prices are able to cover the average variable cost. Therefore, what is more important in short run is the average variable cost AVC curve. Production will be at a point where the marginal cost will be equated to the price. So, the effect of tax on the marginal cost is identical. We already saw that as the effect of subsidy on the marginal cost, and both raise the marginal cost relative to the unregulated case. Now, we can see quickly how these subscripts are defined. Marginal cost for unregulated scenario is MCU, while the marginal cost for the subsidy is considered as MCS. And MC taxes, marginal cost taxes is MCT. So this is done for the all the variety or versions of costs. This is marginal cost, and same thing is done for the average variable cost. Average variable cost for unregulated case, average variable cost for the subsidy case is AVCS, and AVCT is average variable cost for taxes. Corresponding to these costs, we have prices on the vertical axis, and the prices are reflected as price for the unregulated, price for the subsidies, and price for the taxes. Now, to depict all of them in the graph, now you can easily see we are more concerned on left hand side when the firms are old, using the old, and new firms are on the right hand side. So you can see the difference between the two is the prices, the gap between the cost and the prices. The gap between the prices and costs is substantial on the right hand side when they are new firms, and it is very minimal on the left hand side when they are old firms. And another thing to visualize or notice is that the average variable cost unregulated, the subsidies AVC gets reduced, while subsidies taxes AVC is increased. So AVC in case of taxes gets huge, there is a huge rise in AVC curve, while there is a fall in AVC curve due to subsidies. And in both the scenarios, marginal cost there is a shift in the marginal cost upwards, and by the equal amount in case of taxes as well as in case of subsidy. So marginal cost curve shifts upwards or increases both in case of taxes and subsidies. This is true for the old firms and the new firms. In the short run, the effect of tax or the subsidy is to raise the marginal cost, and this is true for both tax and subsidies. The subsidy lowered the average cost curve, while the taxes raised the average cost curve, and this is true both in the short run and the long run. We have not seen the long run yet. Now we are going to visualize how the cost changes in the long run. We assume in the long run, there are certain assumptions that we assume a constant cost industry. All the firms will operate under the bottom of their average total cost curves. So we consider a constant cost industry, and in the long run, we also state that the firms are going to operate at the bottom of their average total cost curves. This implies that the supply schedule for the industry will be horizontal, and goods prices will be higher than the. Now we are going to consider in detail the analysis of long run cost after the short break. Thank you so much.